Let's kill the noise. Forex isn't dangerous, but your habits might be. Everyone talks about how risky trading is, but risk is only scary when you don't understand it. The truth is, Forex is one of the most structured, risk-controlled markets in the world, if you know how to approach it. And in this video, I'm going to be showing you why traders who treat Forex like a business end up realizing that it's safer than anything they've ever touched. If this is already giving you clarity, tap like and subscribe, and check the weekly newsletter below where we go deeper every week. Okay, so in this video, we're going to be talking about why Forex is a lot safer than you think. Truth number one is that risk is always defined. Unlike stocks or crypto, Forex lets you define your exact risk to the pip. You choose your lot size, your stop loss, your exposure. What I mean is not day trading stocks or crypto. What I mean is that investing in the stock market, maybe for a month or maybe years for you to get your return. Or crypto, maybe you're investing in an altcoin or meme coin that probably is going to blow up tomorrow and guarantee you overnight success. But at the same time, you're risking a lot of money every single day to potentially maybe change your whole entire life. Now, the reason I say this is because with day trading, you can be a couple hours in the market and then leave. And you probably don't have to day trade for the rest of the week, maybe even the month if you've gotten that size of the account. You choose your lot size, you choose your stop loss and your exposure. You tell yourself, hey, I want to risk that much and I want to leave the trade when it gets to that point, and I want to make sure I have that much exposure in the market. It's all preset. There are no surprises unless you're winging it. Now, if you enter the maximum lot size or you don't even have a stop loss, plus you don't know why you're in the market when you're in the market, for sure, it's not going to be safe. But it's the same thing with everything that you do in life, right? You have to kind of control the risk, limit the downside, and the upside will take care of itself. Moving on to truth number two. And by the way, for these truths that I'm telling you right now, why Forex is safer than you think, it's not for you to choose one of the above. It's for you to combine all of them together and say, oh, that makes sense, you know? So you could trade with the tight structure, right? If you do that, then it's safe. Set up daily max loss. Tell yourself, hey, I want to lose 1% and that is it. Not more, not less. That is it. 1%. Risk 1% per trade, have a system, and guess what? You've just eliminated 90% of the chaos other traders complain about. Everybody says, hey, I just breached my account. I just overtraded. I just revenge traded. I just over leveraged. All that kind of stuff adds up into having that emotional battle with your own self and no mental clarity, just extreme blur. Most risk is emotional, not even structural. If you think about it and you structure your own risk and you kind of delete your emotions for the time being, for the time where you're on the charts, you have nothing to worry about because you know worst comes to worst, you're going to lose 1%. But hey, it could be a lot better because when you win that one trade, which respecting a risk to reward of a 1 to 3 at least, you probably need to lose 3 times in order to make back one win, which is, hey, like this is a lot of money. If you think about it, let's have a 100K account, right? A 100K account and you take 4 trades, right? 4 is the number of the trades. You lose 2 trades and you win 2 trades, right? These 2 trades that you lost $2,000. So minus $2,000. The account, when you take these 2 wins, is plus $6,000 because these 2 wins are $3,000 each because it's $3,000 of 3% of the $100,000. So now in total, you have made $4,000, right? These $4,000 are just made this week. And maybe 4 weeks in, you'd be up $8,000. Now you're up $8,000 investing approximately $497, if I'm not mistaken. That's what a 100K account costs. So you paid $500 and you made $8,000 at the end of the month. That for me is a valid investment. So think about it. It's not emotional, it's structural. We're going to move on to truth number 3. And for truth number 3, I want you to know you control when you trade. Forex is not 24/7. It's session-based. Think about it. If it's a pair, GBP, USD, right? Well, the Great British Pound and the US dollar together, you don't need to be trading Asia session. That's just you entering early and getting wiped out by the market, and you are the liquidity. So if you can understand that all you gotta do is be there when the session is opening, or when you have that time window where you can kind of execute, because this is how you get paid for trading. You can't kind of predict the market and say, oh yeah, I predicted this. Well, you didn't take the trade. It doesn't make sense. You don't get paid for predicting. So you can show up for London and be done by New York. And that is the reality. You can have your money be made by the London session, and you don't even have to trade New York. So if you wake up at 3 a.m. like me, I wake up at 3 in the morning, I take my trade probably by 4, maybe 5, maybe 6. Sometimes I leave it running for the rest of the day. But let's say I took my profits at the London market. I don't even have to work for the rest of the day. Sometimes the rest of the week. Sometimes the rest of the month. If my trade goes to a 1 to 10% of my accounts, I'm trading with 2 million, but what I do is I have $1 million set on the side and I trade with 1 million. If I make 10% of that, that's $100,000. Now, I'm not going to tell you I make this in 1 hour and I'm going to kind of bamboozle you with all that kind of social media fluff. What I'm going to say is that sometimes, maybe once in the month, I get that trade play out. Sometimes it doesn't get to a 1 to 10. Sometimes it gets to a 7, sometimes an 8, sometimes a 6. But still, that's $70,000, $80,000, $60,000. Think about it. I could enter at London session, and then when price goes to my 1 to 3, I move my stop loss to break even, and then I let the trade play out. So when I hit my 3%, which is the $30,000 for me, right? I have these $30,000 being hit. I move my stop loss to here, and then everything after that is profit for me. I can go to sleep. I can wake up having the best sleep ever, actually sleep like a baby, and wake up maybe in profit, maybe back to break even, but I've already secured my $30,000. If for some case my trade goes up to 6 or 7 or 8, I won't have to trade for the rest of the month. I'm not trying to be successful overnight. I'm trying to stack these wins month by month in order to be successful. Now, this is what I want from you. This structure gives you the rhythm, routine, and a schedule to master. Do whatever works for you. Maybe you like the London session more than New York. Maybe you like the New York more than the London. You don't have to trade both. And you certainly don't have to be there 24/7 trying to flip your whole entire thing. And this happens a lot. People that buy their account on a Friday, and it's probably 2 p.m., don't try to make your 10% and pass the phase by then. You don't even know what's going on in the market on Friday 2 p.m. It's going to close for the next 2 days, and Monday sets the narrative for the rest of the week. So you don't even know what you're doing. If you bought the account on Friday, it doesn't mean the market has to move on Friday. You're supposed to wait. Give yourself a month, pass the account, do the same thing the next month. That means you've already made 9%. Just do the same thing again and make another 9%. If it's a $100,000 account where you paid $500, that's $9,000. So think about this and then move to truth number 4, right? Truth number 4 says price action gives you the blueprint. Forex respects structure, consistency, discipline, commitment, supply and demand, liquidity sweeps, breaks of structures. This market moves with logic. Think about it. You mark your zones and you want to see. Price is fueled by liquidity. Liquidity is the fuel of price. This is why price moves the way it moves. If you have your supply and demand being set up, if you know where the break of structures are, if you know the liquidity sweeps, if you combine them together, and if you go to the lower time frame confirmations and make sure you have the narrative being set up, you have the thesis being cooked, and you know exactly what the next move might be, you don't need to predict the whole move. You can predict a portion of the move, make your money, and leave. And this could be an hour, maybe 2 hours, maybe 3 hours, maybe leave it running for the rest of the day. But you're not going to be holding a trade for a week or 2 and have it consolidating in the break even as soon as you enter the trade. That all doesn't make sense. We want to focus on tap and go. Have your trade being set up. If it hits, it hits. If it doesn't, don't chase it. That's all that I'm going to say. Now, once you learn these patterns, it becomes less about guessing and more about reacting. That is what I always tell my students. I don't want you to be predictable of the market. I want you to be reactive. I want you to be dynamic. If the market does that, then I'm going to do that. I don't want you to say, I think the market's going to do that. So because I think the market's going to do that, I'm going to do that. It just doesn't work and it doesn't add up. And notice how the last sentence that I just said doesn't even make any sense. This is what you do. And this is why you're not profitable yet. So moving on to truth number 5. And then I'm going to be giving you J tips, which are my tips, basically a whole summary of the whole thing. The market isn't dangerous, you are. The market is a reflection of you. It's a mirror. If you are being able to be the best version of you, waking up at the session, trading only within the sessions, having your zone set up, waiting, not chasing, thinking before entering, not over trading, not over leveraging, not revenge trading, none of that. Just focusing on exactly what's been working and doubling down on that and being able to look away when it's not yours. That is what the market wants. So, most bone accounts come from over leveraging, not losses. From over trading, not the pair. The market's just doing what it does. You're the variable. Think about it. The market is not evil nor good. It just is. And you're the one changing. You start from being a bad trader to a good trader to a profitable trader to a great trader. So this rhythm is going to happen, and that process is going to happen. So the sooner you accept that it takes time, the faster it will come to you. For my J tips, Forex becomes safer the moment you become structured. Get your rules, get your mindset, and you realize this isn't gambling, it's controlled aggression with a system. Like I always say, controlled chaos. Now, that is all for this video. I would really appreciate you to tap a like, even subscribe, and click the link and be a part of the juice letter. See what I just broke down over here? This could be yours for free every single week. I'll be sending it out to your email. All you gotta do is just click it and it's yours. And as always, I will see you on the next one.